Welcome to ICSE Warriors. Today we're going to learn chapter 2 of the ICSE Maths concise textbook of Selena, which is banking. It's the most easiest chapter and it's also one of the best scoring chapters in the whole portion. So let's begin with a little bit of theory. And in today's video, we're going to cover only theory parts. We won't be solving sums today. Introduction. The business of receiving, safeguarding, and lending of money is called banking. This is a very important line. When we go down, we understand the types of account in a bank. All of us know how a bank is used, how do its functions work, like if we want to deposit some money, if you want to withdraw some money, if you want to take a loan, and all of those things. And in this particular chapter, banking of class 10 ICSE, we're going to learn about recurring deposit accounts. So in simple basics, we deposit some principal amount every month and it compounds monthly or quarterly based on the scheme, and then it builds up to a maturity value, which is the lump sum amount which is given to us. So let's read this one paragraph properly. Under this scheme, a depositor chooses a specified amount and deposits that amount every month for a fixed period, chosen by him or her at the time of opening his account. This period may vary from 3 months to 10 years. 3 months to 10 years. At the expiry of this period, called the maturity period, the depositor is paid a lump sum amount called the maturity value. The maturity value of an RD account includes the amount deposited by the account holder together with interest compounded quarterly at a fixed rate. This rate is fixed by the Reserve Bank of India RBI and is revised from time to time. So what is the maturity value? The sum invested plus the interest earned on that amount, right? So moving down, we have these formulas. This is about the chapter of banking specifically. So there are 3 to 4 main formulas which we need to learn and understand properly. So just to understand P and N, P is the principal amount, sum invested every month. It's the sum invested in the bank every month. N is the duration, the time period in months. Okay, so if it's 2 years, we calculate it as 24 months. 1 year is equal to 12 months. And R is the rate of interest per annum. So in banking, money deposited is equal to P, that is principal into time period. Money deposited is equal to principal, the amount into number of months you have deposited it, right? That's the money deposit thing, P into N. Interest is equal to P into n plus 1 upon 2 into 12 into r upon 100, right? So how do we understand this? This is the principal amount, P is the principal, N is the time duration, n plus 1 is equal to time duration plus 1 into the rate of interest r divided by 2 into 12 into 100. So what changes here is P depending on the principal invested every month, N the duration in months, and N into N plus 1, that is duration plus 1 into R, the rate of interest per annum, right? This is the interest formula. And when we combine both of these formulas, P into N and P into N plus 1 into 2 into R upon 2 into 12 into 100, it forms the maturity value. Because money deposit is only principal invested, right? And interest is the money earned. Maturity value means money deposited plus interest earned. So P into N over here uh, depicts the money deposited, and here P into N plus 1 into R, 2 into 12 into 100 deposits like replicates or tells us the interest, right? So this together, we add the interest plus the money deposited, it forms the maturity value. Again revising, P is the principal amount that is invested every month. N is the duration, time in months, time period. And R is the rate of interest per annum. Per annum is very important. And the interest is compounded quarterly. It can come as an MCQ. And final, but the most important part of this chapter, which most people miss, is the qualifying sum. We don't have to understand the theory behind this formula, but this is a formula which definitely comes in an MCQ. This is a very important formula which most people miss while reading the textbook and which most people don't know before the board's exam. So please understand and learn this formula. You don't need to understand it specifically of how it works, but it's important to learn this formula. So the formula goes as principal into time, time plus 1 upon 2. So P is the sum invested every month, N is the duration in months, N plus 1 is the duration in months plus 1 divided by 2. So this is the qualifying sum formula. This is very important. This can definitely come in an exam for 1 mark. So please learn this formula. It's a very easy. Thank you.